Hello and welcome to Fitch's next installment of its virtual investor series. I'm Deborah Ogawa, Senior Director in U.S. Structured Credit, and I'm joined today by Derek Miller, Head of U.S. Structured Credit, and Matthias Neugebauer, Head of EMEA Structured Credit. Let's get started. Matthias, we're now a year out from the trough of asset quality weakness in CLOs. Is the worst behind us? Are there many CLO notes still on rating watch or negative outlook?
I would think the worst is behind us. I think we're seeing a fairly strong and recovery despite concerns over variants of the virus in most European countries. And we see the credit quality indicators such as the Fitch WARF, as well as the Fitch CCC bucket falling, both of them coming down. They have been stable pretty much since the second quarter last year, and they're gradually falling or have been falling for the last 3 to 4 months. So we see improvement there. They're not at the level where we were pre-COVID, but they're heading this way. So there's improvement. At the same time, our loss forecasts for this year and into next year are also coming down and being revised. So overall, we see improvement in the portfolios. And of course, managers also took the opportunity to counter negative credit migration in the portfolios. They were selling CCC assets actively. The market returned towards the end of the second quarter and allowed managers to take advantage of that and reduce the CCC exposures and exposure to the most affected sectors. So those sectors mostly affected by the lockdowns in the various countries. And that helped as well. As a result, we saw fairly few actual defaults in the CLO portfolios, but of course that came as a loss. Selling a CCC even at the recovered market value meant that the managers crystallized a loss, and as a result, most of the CLOs are now marginally below their target par by approximately on average 50 basis points compared to pre-COVID when they were marginally above target par by about the same amount. So there's a small deterioration. All the CLOs are passing their OC tests. So generally, I think they've weathered the crisis fairly well. And in terms of your second question, we still have just under 20% on negative outlook, and we expect to resolve those probably by the end of July. So we are actively going through the existing portfolio and changing the outlooks to stable again. So in our view, the worst is behind us. We have seen migration in terms of ratings, mostly at the BB level, where we changed some ratings to BB minus. We have not downgraded anything across categories, and we have not had any downgrade to the CCC level. Are these going to be changed back? Well, we recently saw quite a wave of refinancing and resets, as a result of which the managers were able to reduce their cost of capital. That was credit positive, but at the same time, managers opted to extend the weighted average life and as well as update this collateral quality test, and that constrained upgrades. And I would say that is the general process that we've observed in the last couple of years, that if there's positive development, either shortening tenor or improving credit quality, managers took advantage of that and updated their CQTs for transactions that were still in the reinvestment period, as a result of which that constrained our upgrades. So I would say upgrades I would only expect once transactions leave their reinvestment period.
Great. So that sounds good that it's the worst is behind us. How about in the US, Derek?
Well, sure, Deborah. In the U.S., I would agree that it appears as though the worst is behind us. Really, what we've seen in terms of U.S. CLO portfolio performance, we've seen continued improvement over the last 12 months from a trough in May of 2020. For instance, the current default percentages in the portfolios is actually at a 24-month low. And when we look at the default forecast for the remainder of 2021 and even into 2022, we see relatively low default forecast for leveraged loans, similar to what we've seen over the last 12 months in leveraged loans. And I think another key metrics when we look at the portfolio and the performance and that improvement over time is really back to pre-coronavirus in late 2019. The weighted average rating factor was 33.4 at the end of 2019. It's back to 34.3 and that's relative to a peak of 36.5 a year ago. Another metric we look at when observing portfolio improvement and performance has really been the extent of the underlying portfolios on rating watch negative or outlook negative, and that level is nearly half of what it was in 2020. So in May of 2020, we saw a little over 40% of the portfolio with a rating watch or outlook negative, and now we're down to about half of that. And all this has really had a knock-on effect in the U.S. market with respect to robust new issuance activity, reset activity, refinancing volumes for CLO notes, as investor confidence has increased. And that's really continued to drive demand for the CLO liabilities during the first half of the year. And with respect to how that's played out in CLO note ratings, at this time, there are no U.S. CLO tranches on rating watch negative, and all U.S. CLO notes backed by portfolios of broadly syndicated loans in the DLV category or higher have a positive or stable outlook. Similarly, we see only a small number of tranches from middle market CLO notes that have a negative outlook. However, we do continue to see signs of improvement in those portfolios as well.
Great. Let's turn to asset managers now. Derek, I saw that the 10th annual US CLO Asset Manager Handbook was just published. When surveying managers this year, were there any notable trends or areas of focus?
Yes, there were. Absolutely. So 117 managers globally participated in our CLO Asset Manager Handbook. The handbook provides a unique Fitch view of managers where we reflect our view of the manager's qualifications, strengths, potential areas of concern, and any mitigating factors. The new item this year is that we applied a special focus on surveying each manager's implementation of ESG into their investment process. And about 90% of managers that participated in that survey represented that they have stated ESG policy. And then about 2/3 of those managers also indicated that they're part of an organization that is a signatory of the UNPRI. In conjunction with our survey of CLO managers, on their adoption of ESG, we also published a special report on ESG Compendium where we provide insight into how CLO managers are actually incorporating ESG factors into their investment process. And the range of their responses reflect the different stages of their implementation of ESG in their investment process. In addition to the manager's individual responses on 10 specific questions that we asked around their implementation of ESG, many managers also agreed to provide additional commentary where they helped illustrate the challenges that they're facing as they implement ESG framework in the context of leveraged loans and CLOs. One of the highlights of the report is that many CLO managers believe that their credit analysts are actually in the best position to assess ESG impact within their coverage. And we see many of the larger institutions more likely to have specialized ESG teams to facilitate consistency of an ESG approach across their entire business line.
Interesting. One other topic I want to touch on is documentation. We have seen more and more CLOs in both regions adopting rescue financing terms in their indentures. Does Fitch have any concerns with this additional flexibility such that CLO managers might be putting good money into weak assets? Matthias, how about we start with you?
Well, that's exactly it, right? You're giving extra or like they're using cash to invest in defaulted obligors. That is not really the idea of CLOs. CLOs are performing credit strategy. The eligibility criteria restrict managers to buy performing credits. But of course, distressed funds that focus on that area know that too. And CLOs make a lion's share of the leveraged loan market. So they know how to set up restructurings to disadvantage CLO asset managers. And I mean, the classic one that has been around and managers knew that since the financial crisis, where that new money comes in super senior and crumbs down existing senior secured lenders and put them in a weaker position and therefore deteriorates their recovery prospects. So for that reason, we have observed, I mean, pretty much since the first CLO 2.0, the concept in European CLOs, the concept of corporate rescue loans, which is sort of a contractual way of mirroring the debtor in possession loans, the legal concept in the US, in Europe. It has to be the most senior position in the capital structure, or it was aimed for that. And that didn't quite work, for example, last year in an example of Codere, a Spanish company, where you had a revolver that was ranking on top of that. So you couldn't really claim that this is the most senior exposure. So as a result, European managers adopted the concept of loss mitigation loans last year for the European CLOs. And I think since the first one, believe it was a GSO transaction, it is included in all new primary CLOs in Europe. And that gives more flexibility to managers to handle such restructurings, and with the aim to maximize recovery prospects or recovery proceeds from defaulted obligors. But of course, nobody knows, and you don't have foresight. It could also go wrong, right? I mean, we have seen that in other structures, that even super senior was then not enough when the company continued to deteriorate. So unless there are conditions around the use of basically cash proceeds for such structures, we would obviously make an adjustment day one, and everything else being equal, the manager would have, for the same ratings, less leverage. So there's a cost incurred of that. So we would assume that this strategy goes or like it adds to or creates additional losses. And therefore, the loss mitigation loans that we have seen, the concepts have conditions such as using principal would only be allowed if you're still above target par, because we analyze to target par and we wouldn't make any adjustment as a result of that. And if interest is used, the OC test should be passing. But that immediately shows up that that constrains the flexibility of that instrument again, because if we have to be in a fairly benign stress that the OC tests are all passing and the funds are above target par. So more recently, we saw proposals where the conditions were weakened. And in that case, we started to apply additional stresses. So it's always a trade-off with this concept. Additional flexibility may come at an additional cost.
I get it. Okay. Derek, anything to add from a U.S. perspective?
Sure. I think Matthias' summary is a good one. I would just add from the U.S. market, we've really seen the more prevalence of these rescue financing provisions, and it's become more popular since late 2019, and it's really grown in popularity and common usage across transaction documents since then, up to a point where we have about 90% of transactions in the first half of the year that are able to participate in rescue financing in some form or another. I'd say one of the mitigating factors in the U.S. market is that we tend to see the level of the type of purchases being permitted under these provisions be fairly limited in portfolios. So they are limited in terms of the bucket size and the provisions that will actually occur. The other item is that while the usage of rescue finance language has increased in CLO documents, the language is anything but common across transactions. And so when we look at CLOs, and we comment on this in our new issue and pre-sale reports, we look at CLOs and we talk about and we describe kind of 11 key areas of assumptions and capabilities that the CLO manager may have under the CLO documents when financing rescue type loans or rescue type assets. So we do publish that in our pre-sale new issue reports, and we comment on any outlier factors that we believe where we need to apply additional stress in our analysis, and we document that for investors.
Good to know. Thank you. Well, that's all we have time for today. I want to thank you for joining us. If you have any questions about the topics we've discussed, please send an email to the address you see on your screen. Many thanks, Derek and Matthias.